Good morning, everyone. Thanks for all being here. So today we have a panel with amazing investors here who invest across the spectrum, and we'll love to talk about the growing appetite of Southeast Asia investors. How big should it get? So before we kind of go into the session, me, Steffi has kind of introduced ourselves again, but maybe let's go through a little bit so we can understand kind of your funding amounts and stuff like that. So again, personally for me, I've spent the last 13 years across media and tech startups, mostly in Asia, a little bit of Silicon Valley, and I just returned from Paris, where most recently I was an entrepreneur in residence at Entrepreneur First, which is a deep tech investment fund. And yeah, that's me, Martin.
Hello, everyone. Martin from Hubert Burda Media and Burda Principal Investments. Burda Principal Investments is the investment arm of Burda, and we invest off the balance sheet of Hubert Burda Media. So we typically do Series B, Series C financings, and we do that in the US, we do that in Europe, and we do it in Southeast Asia. Average ticket size, I would say about 8 to 12 million US. That's what we do.
Thank you, Martin. Koi.
Hi, my name is Koi Lim, co-founder and managing partner of Monk Seal Ventures. Monk Seal Ventures is an early stage venture capital fund based in Singapore. We've been here for about 5 years now, operating out of 2 funds, investing typically at the Series A stage across Southeast Asia in the software-enabled businesses space, ending between $2 to $7 million US in the first check.
Thank you, Koi. Terrence.
Hi everybody. Terrence Lee from KKR. I'm based here in Singapore. I cover the TMT sector in Southeast Asia. Been at the firm for about 10 years. People know KKR for our later stage buyout investments, but what they don't necessarily know is we're also a prolific growth investor. So tech is actually the biggest single sector that KKR has invested in. We invest all across the chain. So obviously doing buyouts and later stage investments, but we also do earlier stage tech growth type investments where our check sizes start at 25 million and above.
Hi everyone, my name is Anand. I'm from Sequoia Capital in Singapore. Thank you to DLD and Burda for having us. We've invested across the board in multiple different geographies since the firm started about 47 years ago. And Singapore is actually our newest office where we invest in companies across Southeast Asia, primarily focused on tech, but really we are very sort of flexible in terms of finding the right set of opportunities as long as it's a interesting large market with a fast-growing business. It's something that we're interested in. As far as stage of investing goes, we actually have different pockets inside of Sequoia. So in Singapore, we invest everything from $1 million seed check to, excuse me, about $30 to $35 million growth checks. But then we also have global vehicles of capital that we can use to invest upwards of $100 million and more. So pretty flexible across the board. But really, I would say our bread and butter over here is early stage, seed, Series A's, and some Series B's.
Thank you all. So you can see we have a range of investors across geographies and ticket sizes. So kind of like set some context, right? So Southeast Asia here, we have 570 million people, internet population of roughly 360. And with the industry report by Google, Temasek, and Bain, they've been revising the report. So last year they predicted that 2019 will do, or last year we did 72 million across the entire internet industry economy. But this year we've reached 100 billion, 72 billion to 100 billion. So we increased almost 40%. And this was much more than expected, right? And now in the region with 11 unicorns and another 70 that's like expiring unicorns where you're looking at these companies potentially getting bigger. So with these numbers kind of in play, people are saying that we are at an inflection for Southeast Asia tech. And the question is it really it? Like what are the variables that are pointing towards this kind of change, this inflection? Anyone can start.
I'm happy to go. I think from our perspective, we do agree that there is an inflection. We moved to Singapore and started investing about 5 years ago. And it was actually a very pleasant surprise to see both the quality of the companies and the quality of the business and the teams that are building out these businesses over here. What we had been somewhat more disappointed by was we thought that the opportunity set available in Southeast Asia is much larger than the number of companies going after that opportunity set. So there was a bit of a disconnect when it came to just the number of founders out there. Now, I think market caps across tech in Southeast Asia have grown, but most of that market cap does end up accruing to some of the bigger guys as they keep getting bigger. So, the incremental $1 billion of market cap typically tends to go to the larger guys. For an early stage investor like us, what we are much more concerned about is, if I was to use sort of more of a marketing term, what is the top of the funnel? Like, how many people are starting companies? What kinds of entrepreneurs are out there? What kind of ideas are they going after? And what we found is that the best way we can serve the entrepreneur community is really to find them very early and help them develop ideas and help them build companies from scratch, because the opportunity set is massive and I think we've barely started to scratch it. So at least from our perspective, we are very optimistic as long as we can figure out just how to get more companies out there.
So we've been fortunate to have invested in companies pretty early, about 5-6 years ago, and I've been back in Singapore for about almost 20 years now. So if you look at a 20-year time frame, the last 5 years has really been an inflection point. And in our investments, we have done companies, particularly in the B2B2C space, places like logistics, payment, etc. And that we have truly seen some real numbers, right? Growth rates of 30 to 70% month on month, doubling, tripling in terms of volume year on year. And so when you look at the bottoms up kind of view of the world, these are truly activities. The question that we ask is, are these sort of incentives-driven activities, or are these fundamentally behavioral shifts? And I think we have spent enough time on the ground and spoken to enough people and lived the lives ourselves to realize that these are truly fundamentally behavioral shifts. I don't think guys are going to go back to a very different kind of world that's offline 5 years ago, right? So my bet is going to be more online.
I think you guys are absolutely right. I think what is positive is that the investment ecosystem is also coming together to actually push that. I remember we started our office, first plans were in 2015, and then we opened the office in 2016. And I remember we were the second Series B fund only. There were only 2 Series A funds who went into the second fund. And, it sounds like the medieval ages now. This is 3 years ago. So we're just seeing something, I'm not sure about inflection point, but it feels like a rocket we're sitting on. It feels like something that has more dynamism than anything that we're seeing in Europe, and even in my opinion, even than we're seeing in the US.
When you came in, do you feel like the rocket looked very, very promising back then, or does it look way more promising now? Like, was it equally evident?
Well, it was a bit of a jump, of course. And after starting our investment offices in Munich and London, we said, okay, what's next? And we decided on Singapore because we feel it's a absolutely fantastic place to be. And we saw a lot of activity at the very early stage, at seed, at Series A, but they called it Series B Death Valley. And there was absolutely no one here to actually pick up all of the entrepreneurial activity that we saw. When we look at the region now, there's lots more financing available, there's lots more firms springing up, and even on the growth capital side, I guess with Sequoia, KKR, there's a lot more firms actually now moving into the space. I don't know. Why did you decide to come here?
First of all, I agree with everything that's been said. I think the big picture, the macro and demographics in this region are amazing, right? So the economies are all doing well, people are getting wealthier. The demographics of proportion of young people, people entering the workforce, more women entering the workforce, and then smartphone penetration, urbanization, all of these trends are extremely positive in this part of the world, right? I think that's one key trend, and that has been building for a while. But consumption tends to follow an S-curve, right? So once you cross an inflection point, that is when you suddenly see a lot of change in behavior, and I think that has already happened. I think the second positive thing is 5 years ago, there were not that many homegrown, innovative companies and homegrown founders. Right? That is very different today. So once upon a time, you could say Southeast Asia, a lot of Me Too companies. I think that is completely not true today. You have a lot of homegrown, very smart, young, entrepreneurial people who are inventing business models or taking business models from other parts of the world and adapting them because they know the local situation the best. Right? So one thing that we really like to do is back local companies. Right? So in this region, you get a lot of local companies fighting with a lot of foreign companies who set up in this region. We always back the local, almost always.
kind of to your point earlier, right? I think a lot of money has been poured into the companies here, but a lot of them just accrue, and Martin, also you were saying, to really the unicorns of the world, right? Of this region right now. So the question then is that when we talk about the growing appetite, there's more money, the growth equity people, you're moving downwards, maybe upstream to more Series A, Series B checks maybe. Are we talking about, are there enough startups to kind of take all this money? Is it warranted, for example? And Martin, kind of linking as well, Martin, you were saying a few years ago there was a Series B gap, but now the gap, is there still a gap? Has it shifted?
Well, we don't perceive the gap to be there anymore. Now, the question is, are there enough companies to back? We're lucky, we're just a small fund, so we only need to find a couple of firms every year. And so far, we've been extremely lucky. We've built a wonderful portfolio here. Some together, of course, with the guys from Sequoia, and it's been absolutely fantastic in meeting all these companies. And so far, for us at least, there haven't been any limits on the growth that we have. We're more constrained by the capital than we are constrained by the opportunities.
The idea of are there enough companies to absorb the capital? I think from our perspective, it sort of boils down to this human capital gap that exists over here. And I was thinking about that the other day because we have offices in China, in the US, in India, and obviously in Southeast Asia. And our founders in China and India are actually, for the most part, domestic entrepreneurs. A lot of them obviously are folks who've been educated internationally and have moved back to their home countries. But for the most part, to be able to build a business in any of these countries, you need to have a homegrown team. The US is famously different, right? It's an immigrant-driven economy, and a lot of investors talked about how immigrants have created some of the largest companies in the world, and it's true. I think Southeast Asia is a lot more like the US than it is like China and India because of both necessity and openness. Necessity because I just don't think we have enough human capital over here. We should have a lot more engineers, we should have a lot more schools. The number of people trying to start companies should be more. But the flip side of that is we're such an open economy that it makes it very easy for founders to move in from all over the world when they recognize this opportunity set. So if you were looking at our portfolio in Southeast Asia, off the top of my head, I would say between 30 to 50% of the companies that we've invested in have at least one founder who's not from the market that they're operating in and have moved there to start a business, which is actually...
From another Southeast Asian country or from outside Southeast Asia?
Sometimes from Southeast Asia, a lot of times from the outside. A lot of founders from India, China, some from the US, Europe. So that's actually a very interesting and somewhat unique aspect of Southeast Asia that I think we should sort of double down on and just have more founders here.
Do you find... Corey, something to say?
Yeah, no, I was going to say, if I look at the amount of capital that's been raised and how that's going to be deployed over the next few years, and obviously there's going to be more coming, as a function of the size of the population, the size of the economy, the percentage of that that's kind of been addressed by technology, there's still a lot of value to be captured. And so the capital that's going into it, I think, is still relatively low. The question is strategy, right? What kind of investment approaches are being taken in that capital? I think there's been a lot of concentration in some of the earlier stages. Now we see more and more Series A, B funds. We're seeing a lot of late-stage capital as well, I think. Obviously, the SoftBanks of the world, et cetera, are willing to put a couple of billion very quickly into some of the unicorns. So we're seeing some of the concentration of capital in specific parts of the capital market. But as a whole, I think, there's still relatively lower per capital kind of capital availability.
So I'm glad you brought up SoftBank, right? So SoftBank was a force of nature where, again, a few billion at each time kind of thing. And some argue that with SoftBank capability, they're able to fund companies, and then that company has obviously way more capital to play with. Some argue it's a good thing, and I think a lot of part of the markets disagree, right? So when we talk about kind of investing into the internet economy, should we have more capital like that, like solo funds like that with billions and billions to play with? Is that better, or should it be billions spread out among, say, four of you?
Who's going to take that one?
Well, I guess I'll, I don't think I want to answer that head on, but...
You got the mic now.
No, I would just comment that, of course, capital is useful, right? In a company's life cycle, as its company's growing up, investment comes first and you get repaid on that investment later. So having capital to help companies grow is of course very useful. I think increasingly we have a focus, and I think that in general the market has a focus on finding companies that can build sustainable businesses that are not necessarily capital intensive, right? So all businesses need capital to grow, right? But the very best businesses, once they build competitive advantages and once they build network effects and so on, then they don't need sustained capital to continue to have that lead. Those are the kinds of businesses. They're very hard to find, but if we can find them, those are the very best businesses to invest in, right? So I would say, of course, more capital is better than less, right? But really, the answer to that question is to find the right business model, not necessarily more capital. You're not going to compensate for having an inferior business model by having more capital.
I actually couldn't agree more with Terrence. And from our perspective, we find that one of the things that we really care about is the DNA of a business when it gets started. And these DNAs get created in the first year or two of a business's life. And some of the factors that are, I think, positively correlated with a good startup DNA is frugality, being resource constrained, being capital efficient. These are just things that get ingrained into a company's DNA early or not. And so what we find is that as investors are starting to go earlier and earlier, and the deluge of growth capital is starting to show up at early stages, it sometimes affects fundamental DNA of businesses. And to me, like, that's problematic, right? So, for example, Southeast Asia has been somewhat more immune to that because we haven't had as much growth capital at early stages. And so for us sitting in Singapore, we find that we routinely meet Series A companies that are profitable at a company level, which is actually quite stunning if you think about it. It doesn't happen very much because founders don't necessarily have the incentive to be capital efficient and get to profitability that early. But we see that in Singapore, we see that in Indonesia. And so I think like a little capital efficiency, some frugality is critical, but of course you need growth capital at later stages, and that's what a lot of these guys are providing now.
There's actually one point I'd like to ask. First of all, I fully agree. You need to watch your unit economics and scale then, not the other way around. But there is a challenge, and the challenge that we see in this region very often is that you're profitable at one country level, but then you're trying to scale the business across the region, and then it's a completely different story. We've seen quite a few companies that were very successful in one country, and then exactly what Roshni said earlier on when she was on stage, it is not one region, it is a series of many, many countries, many, many cultures, many, many attitudes, many, many religions, and it is very hard if you're in the consumer internet space, which is the area we're active in the consumer internet space, to actually scale across the region with one playbook, with one team, with one attitude. You actually need to adjust, and that is not something you can do by throwing money at the problem. So that is why I'm a little skeptical of the sort of huge funds who just throw money around. It doesn't really solve the problem. The problem lies more deeply.
I agree with that, and behaviors even in an organization, to build on Abhik's point on DNA earlier, behaviors, processes, what people track gets built in very early in the life of the company. And when there's too much funding at the beginning or too early in the stage of the company, they would tend to have a very different behavior that sort of grows into the Series B, C, D stage. That's very hard to reverse, right? It takes a lot of things to reverse those behaviors. And I think, in regards to the question around the region and how we see companies sort of expanding from one country to another country, we tend to see a 70-30 kind of platform versus localized operational need. But you're absolutely right. The ability to experiment in every single country and be very frugal, careful, thoughtful about that needs to be in the DNA, as opposed to charging headlong and just throwing money at it. So that sort of DNA, behavioral kind of element needs to be built in almost as early as Series A or even the seed stage.
Investing in growth versus profitability, we talked about unit economics, and I completely agree. But to that point as well, there are many companies that, despite take out the capital, yes, you cannot put in more money to enter the region and scale across the entire region. But where's the line between investing in growth for X number of years before you get scale and then you get to profitability?
Who wants to?
Anyone?
I can jump in first. I usually, I think
This is
there's.
a loss-making one.
So I always do I'm the bottom of the S curve, right?
Yeah, exactly.
The J curve.
I'll go next. I'll go next.
I'm always at the bottom of the J curve, so we're always losing money getting in. But I think to Martin's point, the focus on unit economics is so key. There's almost a false dichotomy or trade-off between growth and profitability. It's hard to grow very quickly profitably. I agree at certain stages of life of the company, but it doesn't mean that you can lose sight of unit economics, right? I think focusing on how every single input derives a certain kind of output and that makes sense to scale and put more into it is true at any stage of the company. And regardless of whether you're growing fast or not, that remains to be the truism. So I don't think that sort of changes too much.
I do think a lot of founders end up viewing early stage growth capital as necessary to outcompete competition. And I want to say a couple of things on that. One is we are somewhat fortunate to be in a less competitive market over here. So that happens less often in Southeast Asia than it does in China, India, the US. But it's also reflective sometimes of the fundamental lack of defensibility of business models. If the only thing that differentiates one person versus the other is who can get a check from somebody who's willing to write that $100 million, that's probably not a very long-term sustainable business. Because there's just so much liquidity in the market right now that we've really struggled to find company. If a company is scaling, they will have access to money. And if you have multiple competitors scaling and it's a bit of a race to the bottom, as it is in several markets where there's been hundreds of millions of billions of dollars of capital go in, there needs to be some fundamental business sustainability, otherwise capital is no longer going to differentiate companies.
I think that's absolutely, sorry. I think that's absolutely right. Since the world financial crisis, 2008, 2009, the US Fed has created more than 3.5 trillion in cash. Almost the same holds true for Europe. There's now over $17 trillion in bonds that are negative interest bearing. So there's just a ton of cash out there, and that cash is chasing opportunities, is chasing assets. So we've seen quite a bit of inflation, irrational inflation in pricing in the US. We've seen it in Europe. I feel we've seen it less in Southeast Asia. We might have sort of seen it in China and India, I don't know. I'm no expert, but I think in Southeast Asia, it's still fairly sane. Would you agree?
Yeah, I mean, it's all relative, right? So relative to some of the other crazier markets in the world, for sure. But then even then, we do see inflation of expectations, inflation of prices out here, especially in the hot markets and hot sectors. I think the thing I would add to this discussion is, being in the slightly later stage, right, than you folks, being in the growth stage, the advantage that I have when I look at these companies is many of them have a kind of well on the path to growing up. So by then, hopefully, the business models will be settled down. The unit economics by then would have somewhat settled down, or it's at least we find it easier to form a view on where this is headed, right? So we don't have a problem investing in growth, and it's not a requirement to demand a certain level of profitability at any certain time. But you need to have a view on where this is going, right? And otherwise, it becomes a bottomless hole. Right? Well, why are we putting money into this company just to sustain it and just to grow it if you are not sure where it's headed, right? So we need to be able to form that view, and then knowing that it will be with the company for a long time, they will probably need additional capital, and also market attitudes towards that very question: growth versus profitability, and what does the market want? Because eventually we will have to move on, and eventually the company will go on to the next stage of its life and so on. You have to take all of those things into account. But if you're coming from a position of strength, because the company has the right business model, has the right unit economics, you can make these decisions, right? As Abhik said, good companies will tend to have the financing available. But if you've gotten this wrong in the first place, and then you get into a cash crunch, and then it becomes hard to raise money, and the company's burning a lot of capital, then you've gotten yourself into a pretty tough position.
So kind of across everything, right? Are companies staying private longer, and how would that affect the rest of the market? And then kind of linking that to exits. Koi earlier was also talking about kind of the public markets. And when you look at the global market right now, that companies are going, yes, basically staying private longer and not going IPO. So how is that exit landscape? Is it changing? Will it change? What are your thoughts?
Yeah, I think, it's a slightly more contrarian thought, but, we've always assumed that going public is the end goal for every long-term sustainable business. And I would question why that is the case. It is the case for getting liquidity for investors. It is true if you want to have liquidity for investing in the business. It's true to access capital markets that might be deeper than private markets. But if you look at the world today, the private capital markets are actually, it's unprecedented how deep they are. Companies are staying private longer because they can do it. The scrutiny of public markets is not something that every CEO wants to go through. And from our perspective, what we find is our LPs are all, most of our LPs are non-profits, so they're long-term institutional investors. So they actually give us no pressure at all to sell. We have several companies globally in our portfolio that we've held for 10 plus years, and we routinely get asked by LPs to never sell. We hold on to our public stocks for much longer after companies go public. So if a company has access to the right capital market and has the ability to keep compounding, I don't see a reason for them to go public, except that today the private markets are in a bit of a bubble. People are not valuing companies appropriately. Public markets are a lot more diligent. So standing up to that level of scrutiny is good, is healthy for the business. And that is a good reason, I believe, to do that. But if you are running a well-run business, you can afford to stay private for a much longer period of time than you ever could before.
No, I think that's absolutely right. And what we're seeing is, it's early days here in Southeast Asia. So a lot of the companies have only been around for a couple of years. And it might just be too early. I think the verdict's out. What exactly is going to happen? I think there was a big study on exits done by INSEADS and the guys from GGV done earlier this year. And I think the big exit wave is actually going to start whenever it is, 21, 22. And I fully agree. It's not going to be IPOs mainly. It's probably a lot of private money coming in, a lot of private equity coming in, and actually buying out some of these larger companies.
So moving on to kind of investment sectors, right? Are there any underinvested or overinvested sectors?
I would just make a broad comment that in our region, in Southeast Asia, certainly was the case in India before that and China before that, the large number of consumers and the whole consumer story and demographic story kind of led the investment wave, right? So the vast majority of companies in that earlier stage of the development of the cycle tended to be B2C focused. And that has been playing out in Southeast Asia. Interestingly, like other markets, we are seeing a maturity. Southeast Asia is kind of starting to get towards that maturity where you now see, so B2C is fine, right? And that will continue to get funded, and the consumer story is as strong as ever. But increasingly, you are finding technology coming up to solve business problems, right? So 5 years ago, you would have said there are very few B2B, very few software companies in this part of the world. You are now seeing them happen. So we're starting to spend time on that sector.
Yeah, I do. I think what typically we see is certain sectors get invested very quickly. A lot of founders get into this space. We've seen this at some level in the hailing in the early days, and more recently in the P2P landing spaces in Indonesia, for example. A lot of companies form literally over a period of a quarter or so. But at the same time, you start seeing these companies consolidating very quickly. So you do, for some of these lower barrier to entry business models, you will see a lot of overinvestments very quickly. And over time, as it gets harder to just replicate something without understanding the local nuances, like healthcare, like education, etc., these sectors you're going to see a relatively slower investment, and at some level, I almost argue underinvestment. Right? These are big, hairy issues.
Underinvestment, and also, are they underserved? Are there enough entrepreneurs doing stuff in these sectors?
My observation is there are fewer founders tackling these bigger, hairier problems. But I'm happy to hear from the other panelists as well, whether you observe the same thing.
I think the type of solution that we're seeing here is slightly different. What we see in our investment business in Europe and the US is it's mostly displacement. It's disruption, right? You start a company to disrupt one of the big guys. All of the fintech is going after the banked population that already has 3 or 4 current accounts. What we're seeing in this region is a new solution to a problem where there's nobody to disrupt. You're really creating, it's greenfield. right? So a lot of unbanked population, and you're creating something for the unbanked. So a lot of the consumer internet ventures that we see here really address new problems that haven't been tackled before, and this is what makes this region, I think, so really, really interesting, because you have a lot of entrepreneurial activity in solving new problems that haven't been solved before. Now that's going to take time. The entrepreneurs don't, sort of jump off the trees and suddenly start up a company. That is slow going, but I think it's going to accelerate from here on, and I think there's a bright future.
To the extent as well, not just Southeast Asia, when we look at globally, right, developing economies are roughly similar, or developing economies, the environments are roughly similar. So kind of to a question, are there very uniquely Southeast Asian startups that cannot exist outside Southeast Asia? Like literally not even in Latin America or in Africa or something? And then similar question, are there uniquely Thai, Vietnamese, or whatever companies that can only really exist and thrive in that particular country? They cannot exist in any other Southeast Asian countries.
I don't have very good examples, but a few themes that do seem to have emerged. There's some sectors that are unique to every market that they're in. For example, regulated sectors like financial services have enough nuance that business models that exist in one market may not be able to exist in other markets. So for example, we have a pretty large business in India, and India rolled out this payments infrastructure nationally over the last few years. And that payment infrastructure, I would argue, is more advanced than anything we've seen in any other country in the world. And so a lot of businesses are being built on top of this infrastructure that does not exist elsewhere. Similarly, we find that there are some local, consumer nuances that are just different, right? So in India, for example, we invest in a lot of consumer businesses. Many of them would not exist in other parts of the world because these are brands that are getting created, A, to solve local needs, and B, completely leapfrogging distribution mechanisms that existed in the past.
Can you give us one example?
Of payments or?
Anything.
Sure. We invested in a payments company in India called BharatPe. This is a company which basically was, like in China, QR code-based payments is huge, and some of the big guys have a pretty strong hold over that market. What India did was they basically rolled out this infrastructure that allowed you to do instantaneous bank-to-bank transfers in real time, instant settlement, and which is a complete game changer because if you think about it, I actually can't think of any other country that has it. And so this company went out and basically started to build out a merchant acquiring platform of this new infrastructure that has come up. And the amazing thing about this infrastructure is that it's not getting people with credit cards who are already using digital payments to use this platform. It's getting new people. My mom using, WhatsApp or using the Google products to go and pay online, which she's never done before. And so these are just some examples of markets. Southeast Asia has a few of them as well. But I would argue that some of the more mature countries here have more interesting new infrastructure that has emerged over the last few years.
I think for me, some of the needs are very universal, right? The ability to receive goods that you purchase in a good time, at the right price is important. The ability to pay for things, et cetera, et cetera. But the execution is very nuanced. I mean, Southeast Asia uniquely is home to two of the largest archipelagic nations in the world, right? Indonesia and the Philippines. So when you transpose any sort of problems, logistics in particular, into that geography becomes very different. No one else in the world has the same problem. So we invested in several logistics companies. NinjaVan is a last mile delivery company. Weiss is a warehouse management and trucking company. Stalco is a food supply chain business company. And these businesses have been done before in other parts of the world, but when you kind of put it in the Southeast Asian context, where there's bad roads, a lot of islands, sea, ocean, airplanes, etc., it becomes a very different problem, right?
At the same time, there are companies here that undoubtedly have the potential to really become global companies. Let me just sort of name two that come to mind. One is Zelingo, which of course is a platform for the textile industry that is, has applications worldwide, has taken Southeast Asia by storm and now is expanding to the US and to Europe. That is certainly a platform company that from Southeast Asia will actually follow a global business model. The next one is a company called Hamlet, which is a real estate company that allows co-living. So it's like we work for apartments for young professionals. Brilliant concept, brilliant team, that is pushing this model in Southeast Asia. They're in Singapore, they're in Sydney, they're in Hong Kong, and there's absolutely no reason why this form of living isn't something that should be adopted in Europe and the US as well. So I think there's a very good chance that these companies actually do become global champions from a Singapore base.
Gwen, actually part of our investment thesis is actually trying to identify companies that can do something which is very difficult to do and do it well locally, right? Because that's part of the moat. If you figured out the country, you are more local than others, and it's hard for others to break in. That's your competitive advantage, right? The example I would use here is Gojek. So we invested in Gojek about 3 years ago. Gojek was not the first company to invent ride-hailing, right? Uber and so on were doing it by that time. But Gojek's innovation was they took what was otherwise a four-wheel model and they applied it to two wheels in Indonesia. And when we looked at the market, I can't remember the exact numbers now, but we found Indonesia to be quite unique because it's something like 8 times the number. It has something like 8 times the number of two-wheelers versus four-wheelers, and that ratio of 8 to 1 is very, very unique in the world. It's even much more than the ratio in say India, right? So it's things like that which made us realize that okay, I think this company is quite differentiated, right? They're onto something here, and this is not that easy to copy, right? Because it would require a heavy investment in Indonesia and really understanding the business and what people want and so on. So that's just an example, but I think in Southeast Asia, really, I mean, it was said earlier, but I can't emphasize the point enough, but the countries are really quite different, right? On a demographic level, macro level, they all look good, but you're missing the culture, you're missing the language, the behavior, the trends and so on are really quite different, right? So every country is unique and has its own challenges, but on the other side, if you can conquer the challenges and you can come up with a business model that is uniquely local, it becomes very defensible.
Kind of last few questions. So I think in one interview or something, you kind of were saying, you know, when you invest, you're investing kind of for the next 10 years. I've done my research, you know. You know, you're investing for the next...
Interviews that. I never remember
the
saying
next
that.
10 years, right? So kind of a question to all of you. When you're investing in all the companies now, I would love to talk about timing. And we kind of roughly skirted through that a little bit here and there through the stuff we talked about, exits and stuff like that, but really about timing. So when you're investing in a company right now, so early stage and late stage, obviously slightly different timing issues, right? But how are we looking at it? Especially, but let's touch early stage first. When you invest in something, are you looking to invest in a bunch of companies who will build a world for us for the next 5 years, 10 years?
You know, I'll give you an example from a company that Martin just mentioned where we are co-investors. It's a company called Hamlet, which is the co-living business. And Mike Moritz, who used to run Sequoia, was visiting us in Singapore and he met the company. And I remember in the middle of the conversation, he turned to the founders and says, you do realize that you could be building this company for the next 25 years, maybe the next 50 years. And for us, you know, Mike is sort of a legendary investor. He's somebody we respect a lot internally. But that comment, I think, captures the way we at Sequoia view companies, is that the best companies, time is their friend. They just keep compounding. If you're in a market that is really deep, you know, Airbnb is a great example of a company which, you know, we were seed investors in. I think the first check was like $600,000. And the company's been compounding since then and will keep compounding. They might go, I think the public news is that they might go public next year. But, you know, those guys are not viewing this as the end of the road. It's the beginning. I think Brian wants to build this company forever. So if you have a company that is truly that special and that is truly compounding, our job as investors is not to artificially constrain the company with an exit timeline. It is to build a source of capital and multiple sources of capital that can support the company in every step of the way. And at some point, we will not be the right investors and which we'll step off. But that duration doesn't have to be 5 years, it could be 20 years for Sequoia. And so we definitely view all companies from a very long-term horizon. Of course, not everybody gets there, but the ones that do are the legendary, iconic companies of the world.
Now, this is why it's so much fun investing with these guys. We as Hubert Burda Media was started in 1903. That's been a while ago. We've had how many CEOs since? Anyone venture a guess? We've had 4 CEOs since 1903. So we think long-term. We're long-term investors and we like to back companies long-term. who have a great vision of what they want to achieve. And I fully agree, you need to be in it for the long term, because if you're not, if you're just trading on momentum, I don't think you're going to get superior returns.
Yeah, I think for us as well, when we invest, and we've been through this ourselves at some level, the most successful companies I've worked with have been in there without a timeline in terms of when they want to get out, the founders, the investors. From our perspective, when we invest in the company at the early stage, we're looking at, easily 7, 10, 12 years even. And the reality is that founders don't even think in those time frames. They think about what's the next opportunity, how big it is, and how do you capture more and more and more of it. And some of the folks I used to work with, 8, 10 years ago, they're still the CEO, right? They're still running the businesses, even though they're public now. For them, the game never ends.
And for them, they were good enough to transit from a founder CEO to a...
So that's exactly one of the hardest things to suss out, right? I mean, to be able to size up a founding team that's scalable. And I think, for any one of us who have the ability and the privilege to work on these teams is a privilege. It's very hard to find these teams.
Thank you. Terrence?
Yeah, I don't think the story is that different for the later stage investors either, right? I think, totally agree with what Abhik said. I think, different investors can add different value, of course, in addition to capital, but different investors add different value to a company at different points of its life cycle. Right? So we tend to be growth type investors or later stage investors. We have a certain playbook, we have operational value add, we can help companies a lot. Right? And then it takes a long time to actually do that. It takes time to build value. It takes time to make changes. Eventually, once we've done that and the company is on a good track and so on, then you could say, okay, then we've added what we can. Then perhaps there are other shareholders, maybe strategics, maybe other investors who have a different skill set, who can take the company through its next phase of growth. Right? So the companies we hope can sustain. And we're talking about tech here today, but our legacy is investing in all kinds of companies. Some of them have been around for 50 years, 100 years, and so on. And we want them to be sustainable going forward, right? We have to move on because of this artificial fund construct that has a certain life to it, right? But the companies we want to build forever, right? And to last.
Okay, very, very last question, just end off. So in this audience, we have some entrepreneurs here, and they're obviously raising funding. I would love to just go down the line, kind of getting each of you to kind of represent your fund or yourself, giving me this look. So to kind of just talk about what are your fund's special strengths, or they like to focus on that entrepreneurs should go to you for?
Well, I guess we're a consumer-driven company, and that's what we've been doing for a long, long time. So if you have a great consumer product that you've proven out as a product, and there's a product market fit, if you then need somebody along for the ride to provide you with both capital and operational help, I think we can add something to the party.
Thank you, Martin.
We are a team of operators and founders who have been operating in this market for the last 10 to 15 years now. So I think we bring that, both the founder experience as well as the local experiences, and very close with the founders.
Thank you. Terrence?
Yeah, I'd like to say that we have one of the most complete toolkits as far as private equity firms to be able to help companies. And I mean operational value add. We have hands-on operational experts. We have macro, we have political, ESG, and we have a lot of business building experience. Right? So the value add that we bring is taking well-established companies that have clear business plans, good unit economics, and so on, and really helping them grow up over the next few years to become more mature companies.
Thank you, Terrence. And Abhik?
Internally at Sequoia, we use the term partnership much more than we use the term investment. So if you meet any of our senior partners, they will emphasize to all the young people in the room that you're not investing in a company, you're partnering with it. And so this ethos of business partnership and company building, I think, is pervasive across Sequoia globally. And that's what we spend a lot of our time and effort on. How do we help companies build businesses and not just be the check writers who sort of wait for the next board meeting to get an update?
Okay, thank you so much. So thank you, Abhik of Sequoia, Terrence of KKR, Kuo Yi from Monks Hill, and Martin from Berta Principal Investments. My name is Gwen. Thank you so much.